I'm excited. I'm excited because a lot of folks have made a lot of money, maybe in a market that's been pervasively down for quite some time through the course of this year. But to really generate alpha or outperformance in this kind of market, you really have to have a strong view about the places that are going to be the worst off or the valuations are the most stretched to the upside right now. And for that, we've got two of the best in the business that doing their homework on this kind of thing. So we'll get right into it because I know that we've got a limited amount of time. And maybe, Jim, we'll start with you. From a structural standpoint right now, there's been a case to be made that valuations across the board have been stretched to the tilt because interest rates are rising right now. I wonder, though, in this kind of environment, if there are places that are due for the bigger fall. And are there specific industries that you think are going to be the worst off because of that kind of rate environment?
So, Dominic, first, thanks for having us. And I'm excited, too, because it's great with Stanley Druckenmiller here that we're not the most bearish people at delivering alpha today. So, yeah, as I mentioned today at lunchtime on Halftime Report, one of the things that we're focused on kind of thematically is business models that just simply don't work with higher interest rates. An awful lot of businesses have flourished or survived in an era of ultra low interest rates. And if we're just, I don't know where interest rates are going, but if we're just going to normalize and get away from the zero interest rate policy and QE to something more akin to rates equaling nominal GDP, then there's just a lot of businesses that need to re-rate meaningfully lower because they're so leveraged. So one area that has been mentioned, I know you guys picked up on it and the FT picked up on it, is our data center short, which is our sort of big short right now. And that's a business that is really an ultra low return on capital business that's highly leveraged with negative free cash flows. And that's before they compete with Google, Microsoft, and Amazon, which is a much more longer term to the story. And it's going to be difficult for those kinds of businesses, and I know Carson has a couple that fit that too, where these companies that just have negative free cash flow or even negative EBITDA and massively leveraged balance sheets are just going to find it a lot more difficult to A, keep their valuations and maybe more ominously raise capital in an environment where investors now have higher hurdle rates.
So if those higher hurdle rates are in play right now, and you talk about the idea that data center type companies are poised for the fall, we can think, and when I think of data center, I think of a spattering of different kinds of tech companies that are all part of that ecosystem. Yep. Right? I mean, it could be as simple as the Alphabets or Microsofts, or maybe even chip companies like NVIDIA or Meta platforms. But there have to be places that are positioned worse off. And some of these guys have strong enough balance sheets, right? I mean, the bigger players.
Yeah, the hyperscalers.
Right, right, exactly. So where are those negative profitable companies?
The legacy.
Negative,
the legacy data centers, the guys that are building the warehouses out in New Jersey,
right,
northern Virginia, and suburban Chicago. That's the problem area. The hyperscalers are their enemy. And I've joked that the cloud is the enemy of the legacy data centers, not their business. And REIT investors seem to think it's their business. But the cloud is actually taking market share from those companies. So if you look at a company like Digital Realty, DLR, which is one of the leaders of the largest footprint of these legacy data centers, I mean, they're really growing, I think, at 4% a year. Their NOI, which is a REIT metric, is actually shrinking. And the CapEx is just enormous. They're going to do $2.2 billion of EBITDA this year, and they have $2.5 billion of CapEx. And so really the returns on incremental invested capital in this business have been negative. In DLR's case, just to underscore what a bad business this is, since the business peaked, which was basically 2016, which is when the cloud guys really began to kick in, DLR has needed $11 of capital, incremental capital, for every $1 of revenue, incremental dollar of revenue they've generated. And they have 50% EBITDA margins, so that means that it's taken them $11 of incremental capital to create 50 cents in incremental gross cash flow. That's a 4.5% incremental return cash on cash. They just did a debt deal at 5.5% last week. And if you look at their income statement, if their rates are at 5%, they're paying an implied below 2% right now in their income statement. If their rates were 5%, they did a deal at 5.5 last week, they lose money. And so we've been short the office REITs as well. And the office REITs began the year at 6% cap rates. They're now between 9 and 10% cap rates. And for those of you that know the office REITs, they're down 50% this year. That's how they've re-rated. The data centers began the year at roughly 5% cap rate. They're at about a 6% now. If they were to go to 7, DLR would be down 25% from here. If it were to go to 8% cap rate, which is not unheard of right now in the current environment, the stock would be down almost 50%. So these kinds of things are out there.
But okay, so that's very much a value. I mean, you mentioned the net operating income issues. You mentioned the valuations that we have with regard to where interest. You also, by the way, said you don't know kind of where interest rates are going, but this is very much an interest rate discussion on multiples and basically how much more return you need to get above risk-free returns backed by the full faith and credit of the U.S. government.
Right.
If it's digital realty that you mentioned some of the office REITs as well, are there compelling places to still be short, given the fact that we've already seen a massive revaluation of many of these companies?
So again, it depends. We wouldn't be pressing office REITs here. We were short them at the beginning of the year in much greater amount. But the data centers to us look like they're just starting their re-rate. And I think that again, if you're earning a 4% plus return on capital in an environment where the government's issuing debt at 4%, you've got a problem. And that's before CapEx, by the way. That's the scary thing. And I know Carson's got kind of similar thoughts.
So let's bring that. That's a perfect segue because we mentioned the macro environment and how interest rates are framing a lot of these discussions right now, and that so-called re-rating, right? It's not necessarily that the businesses are terrible businesses, they're just not good businesses when you can find alternative measures of returns elsewhere in the market for a lot less risk. You have been very vocal, and I heard your interview on Squawk Box this morning. You've talked about some of the ESG industries that have been there in the past, but where do you think it's going to be? That re-rating that's kind of just in the beginning stages of happening right now, maybe because of interest rates, maybe not.
So yeah, we're generally not thematic. We look for companies where managements are actively deceiving investors. But when I look back on the past 18 months, a lot of what we've been doing is in green tech. And the reason for that is that so much money has been thrown into that space indiscriminately, and you have a lot of charlatans coming out to basically hoover that money up. And so one of the companies that we're short, and I did talk a little bit about this morning, is Sunrun. Now, Sunrun works for us when investors become more risk averse. So you can tie it directly to rates. For one issue with Sunrun is that when they tell investors they have $4.5 billion of net earning assets, there are several assumptions they use that are ridiculous, such as 90% renewal rates after 25 years, but they discount that back at 5%. So, obviously with a couple of rate hikes since we published on them in July, this is even more absurd. But really, what we depend on is if investors are losing money in highly speculative names, risk aversion returns. And in that type of environment, we think investors see through these fairy tales much more readily than they have previously.
They have to, right? They have to because...
if you're capable of learning a lesson, if you're capable of having your hand bitten by a dog, you might then not go and readily pet that same dog again. So if you're capable of learning that lesson. So that's, if investors aren't, then I should really close up shop because, it's over.
You mentioned the capitalization rates, and it's something that you mentioned as well. I mean, this idea that the hurdle rates are kind of in this certain sphere where they can go higher. With your thesis specifically, when it comes to, and I'm going to try to find a reason to see why some of the people in green energy, alternative energy, are taking the other side of that trade, because there is so much more money coming out with the Inflation Reduction Act, with everything thematically that's happening, with so much more attention being put on green energy. there's a fundamental reason why the sector could grow, or the total addressable market, or the TAM can get that much, the pie can get bigger, and that all of these companies should have, even if a smaller piece but a bigger pie, that they should still do better.
Okay, so when you take a business that at 30% tax subsidies is value destructive, and so where the solar companies got their pop, or the renewable companies, the subsidy, per the previous law, the subsidy dropped to 26%. You just returned it to 30%. But they destroy tremendous value even at 30%. In order for those businesses to be economic, or at least the ones that are publicly traded, because they spend a lot on sales and marketing. I suspect that there's a lot of what's really sales and marketing expense that they classify as other operating expenses. But for those businesses to actually be economic, the subsidy rate would have to be significantly higher. So that's the issue. So to the extent that the subsidy is increased, this just enables companies like Sunrun to destroy more capital or more value in a shorter period of time.
Can I jump in here a second?
Yes, please.
I happen to know this company pretty well. He's being kind to them. This company is the aluminum siding of the 21st century, for those of you that are old enough to know what I'm talking about. It's a roofing company. It's basically a roofing company with a second mortgage subsidiary attached to it. It's not a green company. It doesn't produce solar panels. It doesn't produce converters. It buys them from other people and puts them on your roof and leases them back to you, basically. And it had trailing 12-month operating cash flow before they put up a single panel of negative $900 million. And they have $8 billion in net debt and preferred. $8 billion in net debt and preferred, operating cash flow of minus $900 million for the trailing 12 months before CapEx. That is a science project. And so again, my friend Carson is being very kind to Sunrun, and then they have tax issues and a myriad of other things. But because it's seen as ESG, because it's perceived, that's the variant perception, and that's where you can make a lot of money on the short side, when everybody believes this, but the reality is this.
But what happens, I mean, you also mentioned this idea that a big part of that macro picture is the tax credits that are involved, that there's an incentive being put into place. For me, let's say I don't have solar panels on my house yet, yeah. But I'm thinking about it because everywhere, if I go to my local Costco or I go to my local kind of warehouse club, there's that guy set up at the table right there, and he's telling me all of the economics behind how I can make my bill cheaper over the next 10 years, and the payoff time is this.
They sell the tax credits. They sell the tax credits to Goldman Sachs and Google and other people.
Well, but here's the other issue with rising rates. The solar companies like Sunrun are dependent on the securitization markets because basically they're going to lease you, they lease 70% of the systems they deploy, and then they securitize those. Now, they are not able, they're going to have to pay higher rates on these securitizations. And they're also going to get smaller advance or lower advance ratios against those securitizations or against those leases. So they're not able to jack their pricing of that lease up as much as the rates have gone up because you're going to compare it to what the electricity you currently buy costs. And so that's not going up in line with interest rates. So that's also going to squeeze them as well.
What happens though if I'm one of those millions of Americans who keep reading stories in the media right now about just how expensive my utilities bills are going to be this coming winter? We kind of know the macroeconomic backdrop. We know the geopolitical backdrop for why energy prices are soaring. I've already been told by people in newspapers and media that I should expect much higher natural gas bills in the coming months, that my electricity bills will be incrementally higher, if not much more higher, because of things like natural gas prices and electricity generation and everything else. And I think to myself, but I've got a solution. It's in the sky and it's free. And all I got to do is set this stuff up. There's a fundamental reason why I would want to go after solar, because I think over the next several years, I'm going to be better off for it as a consumer.
Well, over a 25-year span of lease, basically, I don't think that you can expect these prices for nat gas. And by the way, if you have appliances in your home that are powered by nat gas, well, you either have to pay to replace them, turn them into electric, or the panels are not going to solve your problem. But I mean, we obviously have these factors right now, geopolitical factors that are driving up the prices of energy, but I mean, is that really long term? And P.S. in California, one of those factors that's driven it up is shutting down a bunch of power plants and replacing them with solar.
Dominic, it's like my grandma who bought aluminum siding, literally, from a door-to-door salesman from Sears in the 70s, being sold on the idea of higher home heating bills and all that heat leaving her house. And if she put up aluminum siding, it would keep it in. It didn't work out for her, and it didn't work out for Sears.
Okay.
I mean, so these companies are really, literally selling this stuff. It actually is reasonably high cost power. It's not that competitive as you might think with the electric grid, and the returns to the Sunrun shareholders are negative. That's the important part. This isn't a viable business.
Jim, it took years for that thesis to play out with aluminum siding. You know, I mean, they were able to sell that stuff at a fairly decent clip for a long time. I mean, what inning are we in right now?
Well, there's also a financing chain here. So we've talked about the equity side, we've talked about securitization. These solar companies also have warehouse lenders. So in the case of Sunrun, it's Credit Suisse. And so if they can't get securitization done, I mean, Credit Suisse might be left holding a bag here on what's already in the warehouse. But this financing chain is vulnerable in multiple points. So, I mean, if these companies cash flowed, could be a different story.
Yeah.
Is that the same thing for the data center thesis as well? It's got to be slightly different than
the data centers. The game being played with the data centers. One of the constructs would like you to think about again is variant perception, and the data centers are capital-intensive businesses. It's not just a landlord collecting a check, right? They're constantly replacing equipment, and they have to run these things. If they were actual operating companies and not in REITs, so if Digital Realty was an operating company, it would trade at 90 times earnings, declining earnings right now. And so the REIT investors say, oh yes, Jim, but you have to add back the depreciation and it's a REIT and forget all that CapEx. And the companies with a straight face say, oh, the billions of CapEx that we have, 90% of it is expansionary. Only 10% of it is maintenance CapEx, which you should deduct from our results. And if you do the numbers, you realize that it works out like for 150-year life for the racks, the air conditioning units, and all the rest of it inside the data centers, which is of course absurd. So there's a lot of semantics going on here. It does not get away from the fact that this is a tremendously capital-intensive business where stuff constantly has to be replaced or is becoming technologically obsolete. And the little game that the industry plays is say you have an HVAC unit at a legacy data center, and it goes out, it fails, and you have to replace that unit. If you can convince your internal auditors that by replacing that HVAC unit, you will have one new customer, or you can raise rents on customers, you can put the entire ticket price as expansionary CapEx. And that's the little accounting game that they play. Of course, it's maintenance, right? It went out, it has to be replaced. So you see these really uneconomic businesses. Digital Realty is earning 4% on its capital pre-tax, and that's before CapEx. It really is, it's kind of stunning of how poor these businesses are, but yet if you're financing yourself at 1.6% or 1.7%, which they do, or they did, you can lever up and show investors some sort of minor return. At 5.5%, it's a different game.
Jim, have you looked at, have you looked at I guess the next layer of that? If the data center business is that, in your words, poorly run, is that overvalued at this point and is playing kind of a little bit of an accounting game, if you will, with regard to how they can treat certain items, that ultimately then flows downhill to certain other parts of that data center business that are reliant on those centers being viable options for technology.
Yes and no. So the hyperscalers, Amazon, Google, and Microsoft, who are building, in many cases, not only building their own data centers, but they're also tenants of the legacy guys. They equal about 20-25% of the tenants of the existing businesses. So there's a little bit of an interesting dynamic there. But they are building more modern, newer centers, and that will continue. There is growth in data. That's not in question. It's just not accruing to the old guys, to the legacy guys.
What about the people who make the server computers? What about the people who make the chips that go into these things?
So we look at the hyperscalers to see what the real growth in data is, and it's down, really. It's kind of down from sort of 40% year over year to 30%. It's still pretty robust. And again, compare that to the legacy guys, which are growing 4 to 10%. If Microsoft or Amazon were to come out one night and say, hey, take your cloud growth numbers down to 10% from 30, that would be akin to what MCI warned in the summer of 2000 about internet traffic. That would have a big impact on a lot of companies, the companies you're referring to.
Okay. Now, Carson, on your side of things, you mentioned Sunrun. That's the E component of ESG, right? That's the clean energy, the environmental kind of side of things. If you've taken such a perhaps more pessimistic view on ESG as a whole, is there anything outside of clean tech? Is there the S component? Is there a G component that you are targeting or that you're thinking about? Have the fundamentals screamed that there's something else besides solar out there that could be the next target of, say, a revaluation?
Well, I've never met an ESG investor who's told me they've made a single investment based on G. So the G doesn't exist. Like, that's fantasy. The S, I don't know. I'm not really sure what qualifies as S but doesn't qualify as E. So I think that, now, to be fair, there are people who say, hey, this is a conflation of ESG with impact investing. And what ESG is intended to be is you're intended to rank companies in a given industry. This one's most carbon intensive. This one has the best gender pay equity. This one's the most diverse, et cetera. But the way that people understand it, and the reason why so many of these dollars flow to ESG, is because people think investors think it's about saving the world. And so they really think about this E component. So no, I think you have to, if you're going to play this thematically, you look at the green tech. And just to give you an idea of how bad G is, I mean, there's really an inverse correlation between a high E score and the G score. The gold standard for governance, based on what I've observed in this space in green tech, is Tesla. And yet, Tesla is the only large company that I've ever come across that has to self-insure for D&O. So that's, if that's the gold standard of this space in terms of governance, governance is irrelevant to ESG investors.
One of the other places I think that a lot of folks have keyed in on with regard to the ESG trend right now is, in fact, that it's a trend and that it's become marketed in that way and that it's become an impact point. And that whenever I see folks who pitch investments along these lines, they say that you're doing the world a service, that you're starting to kind of make the world a better place by doing it, and you have people really believing that. And for that reason, there might be not infinite pools of money, but certainly substantial ones that go in there. We mentioned the interest rate environment and the overall macroeconomic environment right now. Do you feel as though that ESG fund flow, so to speak, from people who are pitching and reaching out to retail investors, say, hey, save the world, make it a better place by impact investing in this way, do you think that dries up? And if so, is it those clean tech companies that get hit the hardest? Well,
obviously, as liquidity conditions tighten, I mean, everything, all financial asset prices will suffer, or at least, as a general matter. Now, I think and this will be controversial, but I believe that the private sector is not capable of addressing the serious environmental, societal problems that we have. And the reason that the private sector is so vociferously pushes this idea of ESG investing or impact investing, I mean, number one, it's a higher fee product, but in the investment industry, I mean, almost everybody is remunerated based on valuations being high, right? So the higher my AUM, the higher my management fee. And if I'm paid on performance, the more stuff goes up, the more I make as a performance fee. So the investment industry is structurally opposed, basically, to government regulation and legislation in order to rein in the private sector and address these problems. So I don't think you can really address these problems in a substantive way without government intervention. And so the longer that industry and the financial industry can sell the world on this idea that the private sector can heal these ills, the longer they're able to stave off the legislation and regulation that will impact everybody's, in these businesses, impact their wallets.
One of the places that risk assets have seen some of the deepest pullbacks, even before the interest rate driven revaluations that we've seen in the last several weeks here, has been in the Chinese market, has been many of the US listed Chinese names and technology specifically in media that have taken an absolute shelling over the course of the last 12 to 18 months. A lot of that in the initial stages was because of what was perceived, and what I'll just call, because I'm in the West and I don't have to fear the sanctions from these guys, is a government campaign to crack down on these companies, right? That really kind of hammered them a little bit. I'd like to take the time that we have left here to address an issue that both of you have some familiarity with, and that's the Chinese market. It's been very geopolitically sensitive given the current environment between China and Taiwan. Semiconductors have been at the front of that story. Many of these Chinese tech giants have been at the center of that story. I wonder, Jim, from your standpoint, are there still places where China has companies that are doomed to revalue to the downside even further than they are right now? And if so, where?
I'm going to handle that question, deflect that question a little bit, and point out something perhaps even more ominous. And that is, if what is going on in the world, whether it's Russia, Ukraine, whether it's central banks losing control, whatever it might be, weren't happening right now, I think what would be happening in the Chinese real estate market would be front and center for investors. It is, I've long said that Chinese apartment prices are the most, probably after treasury bonds, most important asset class in the world. And they are declining. We are seeing a real estate problem in China over the past 18 months that the government does not seem to have a handle on. And the reason that's important, as you know, is that investment is still almost 50% of the Chinese economy, and that residential real estate is almost half of that. So residential real estate is 20 to 25% of the Chinese economy, which is a stunningly large number. They're still building 15 to 20 million flats a year. And the fact that there is a major meltdown occurring amongst the developers, both public and private over there, is a major story that's really kind of on the back pages of our financial press.
Are you saying that Evergrande is just the beginning here?
Evergrande was the start of it. That was 18 months ago. And there was another default, I think, just this overnight in a different developer. You have to understand that, like Tokyo in the late 80s, almost every large company in China has a real estate development arm. So it's not just the developers. This is endemic to the whole economy there. And I think that we ignore it at our own peril, but realize just how much of Asia is tied into China. It's a big story. And I think we're kind of all, because of other things, it's off the thing, and a focus on tech stocks, as you say, because mostly it's tech stocks that trade in the US, Chinese tech stocks. As Joe Tsai reminded me a number of years ago at Delivering Alpha here, that I didn't understand Chinese companies. You know, it's a tie-in with the government that you cannot get away from. It's the state economic model, whether you're publicly traded or not. And capital going into China just is not treated well, and particularly Western capital is not treated well in China. And this has been going on now for a long time, not just the past few years.
Carson, where does it manifest itself the most in your mind? What does your gut tell you about whether or not there is any kind of a real shoe that's left to drop here when it comes to Chinese companies and their economic viability in this kind of environment?
Well, what the past year and a half have really brought front and center is, I mean, like Jim was just talking about, the state involvement in the economy. And until about a year and a half ago, just would always hear Western economists laud the government in China. Oh, the government's going to do this, the government's going to do that. And these are the same economists generally who freaked out when the U.S. government got non-voting pref stakes in our banks. So it's like there's always been this cognitive dissonance there. But in the past 18 months, investors have really been smacked in the face by the fact that this is not only a totalitarian regime, but it's also capricious. And Xi has clearly judged that he no longer needs or even really highly desires Western capital. So you're rolling the dice. If you take a look at a lot of Fortune 500 CEOs, they appear pretty sanguine. And you might say, well, you know what, if these guys, if they're okay with investing more money in mainland China and they're not really panicked, and this also ties into the scenario in which China attacks Taiwan, if they're not panicked, maybe I should be okay with it. But I would point this out, and this is a reality of the world. I mean, certainly you see this in asset allocation. If you zig when everybody else zigs and you all zig off the cliff, you're not going to really suffer adverse professional consequences for that. You zig when everybody else zags and it doesn't go well, then you're going to have a problem. So just because all of these people, all these Fortune 500 CEOs are willing to increase their bets in China that they had already made, don't take that as them being the smart money here. And by the way, the China invasion of Taiwan, the scenario in which China invades Taiwan, I mean, it is the biggest issue. There is no issue in investing in China or Asia that surpasses that. And like how do you know? Like how do you know whether do you really want to bet that China does not invade Taiwan? Like what's that based on? Because they need the US? I wouldn't make that bet.
Does that mean that Chinese-based, or I should say this, Taiwan-based manufacturers and semiconductor companies are in your mind a hold right now? Don't touch them?
Well, it's interesting because if you're Taiwan, on one hand you could say, hey, the smart thing to do might be to build fab capacity elsewhere in an area that can't be attacked by China. But on the other hand, if you want to make sure that the US and the West rides to your rescue, you don't do that. So yeah, I mean, look, I don't deal in holds, but there's obviously a lot of risk there, and there's a price for everything, but do the prices of these assets really reflect that risk? That's what you have to ask yourself.